In my first year making mortgage loans, there was one question I could not answer. It embarrassed me because I was supposed to be the expert in the room, and a customer asked it, and I had nothing. He said, if the bank creates the money for my loan out of thin air, and by then I understood that it did, then who creates the money to pay the interest? I didn't have an answer. I mumbled something and changed the subject, and it bothered me for the better part of a year until I finally worked it out. And when I did, I understood something that I think is the most important thing a saver can know about the dollar in his pocket. The answer to that man's question is the reason your money is guaranteed to lose value forever, no matter who's in charge. So let me actually answer it today. The question I couldn't answer then: how banks really make money, where the interest comes from, and why the whole thing can never, ever stop growing. Because that last part is where your savings live or die. Start with what we established. When a bank makes you a loan, it does not hand over someone else's savings. It creates the money. It writes your debt on one line and creates a fresh deposit on the other in the same instant. The Bank of England said it plainly in 2014. Loans create deposits. New money, typed into being against your signature. Fine. So the $240,000 you borrowed, that's brand new money that entered the world when you signed. Got it. But here's the part that completes the picture, and almost nobody knows this half. When you pay that loan back, the money doesn't go into a vault. It disappears. It's destroyed. I mean that literally. When you repay the principal on your mortgage, that money is extinguished, erased from existence, the same way it was created. The Bank of England said this part too. Making a loan creates money. Repaying a loan destroys it. Go back to the scoreboard from the first episode. Lending is the operator typing the number up. Repaying is the operator typing it back down. The money isn't moved to another board. It just stops being on the board. It was only ever a number that existed because somebody owed it. So now you've got the full breathing motion of the whole system. Money is born when someone borrows. Money dies when someone repays. In and out. In and out. The entire money supply is just the sum of everybody's outstanding debt at any moment. Let that reframe what money even is. It's not a pile of wealth sitting somewhere. It's a giant ledger of who currently owes what. Now we can answer the customer's question. The bank created your principal, the 240,000. Did it create the money for your interest? No, it did not. Here's the arithmetic, and it's worth doing out loud. At 6% over 30 years, you don't just pay back the 240,000. You pay back the 240,000 plus about $278,000 in interest on top. You pay for the house roughly twice. But the bank only ever created the first 240,000. That extra 278,000 was never created by your loan. So where does it come from? It has to come from money that was created by everybody else's loans. There is nowhere else it can come from. The only way there are enough dollars in the world for you to earn, collect, and hand over your interest is if other people are out there borrowing, creating fresh money at the same time. Your interest is paid out of the pool of money that other people's debts brought into existence. Sit with what that means, because it's the whole ballgame. For the existing debts to be payable, there must always be new debt. More money must always be created than the amount that's being destroyed, or there literally isn't enough in circulation to cover the interest owed on what's already out there. And this is the mechanism behind a number you feel every year but were told to ignore. I built a tool that takes your actual savings and shows you what this constant expansion has quietly done to them. I'll give you the address in a minute. Stay with the machine first, because the conclusion is bigger than any one tool. So here's the law of this system, and no politician can repeal it. It must keep expanding or it collapses. Think of a bicycle. A bicycle stays upright for exactly one reason. It's moving forward. The moment it stops moving, it falls over. A debt-based money supply is the same. As long as new borrowing outpaces repayment, there's enough money sloshing around to service everybody's interest, and the system stays up. The instant borrowing slows and repayment catches up, money gets destroyed faster than it's created. The pool shrinks, there isn't enough to go around, and the whole thing wobbles and crashes. That's not a flaw someone forgot to fix. That is the design. The system is built to require perpetual growth in debt, which means perpetual growth in the money supply. Which means, and here's where it lands on you, the number of dollars in the world has to go up. Essentially, forever. Now connect it to your life. What happens to the value of anything when there's constantly more of it? It's worth less. Always. That's the whole reason a dollar buys less bread every year. Inflation is not the Fed being incompetent. It's not a temporary problem they're working to bring down to 2%. It is the exhaust of a machine that is required, by its own mechanics, to create more dollars than it destroys, year after year, or die. The dollar losing value is not a bug in the system, it is the system running correctly. And that means your savings are in a fight they cannot win by standing still. You put dollars in a jar. The system is contractually obligated to print more dollars every year to keep itself alive. Every new dollar it creates makes the ones in your jar worth a little less. You didn't make a mistake. You saved in the one thing the entire machine is designed to devalue. It's like trying to keep water in a bucket while the people who built the bucket are required, by law, to keep drilling new holes in it just to stay in business. You've seen what happens when the peddling stops. In 2008, lending seized up. People stopped borrowing, loans got repaid or defaulted, and money got destroyed faster than it was created. The pool drained. That's what a credit crisis actually is. Money vanishing from existence. And what did they do to save it? The Fed created trillions of new dollars out of nothing to refill the pool. They called it quantitative easing. It was the same move I made at my desk, run at the scale of a nation, type the money into being. I'll give 2008 its own episode, because the how of it is a story by itself. For now, just hold the shape. The system's only answer to not enough created money is always create more money. So here's the trap, fully assembled. Every dollar is born from a debt. Every dollar dies when that debt is repaid. To pay the interest on all the debt, there must always be more debt. So the supply must always grow. So your money must always lose value. And every tool they have to fix it, every bailout, every stimulus, every rate cut, is just more created money poured into the same leaking bucket. There is no exit inside the system. You cannot save your way out of it in dollars, because the dollar is the thing being expanded. You cannot hide in bonds, because bonds are denominated in the same expanding dollars. Every escape route inside the machine is paved with the same material the machine is flooding. Which is exactly why the thing that finally caught my attention was the one asset that is not born from debt at all. No loan creates a Bitcoin. No signature conjures one. It doesn't come into existence because somebody owed somebody. It is issued on a fixed schedule that was set at the beginning and that nothing can accelerate. Not a credit crisis, not a central bank, not the interest owed on $10 trillion of debt. There will be 21 million, and the pace they arrive at cannot be sped up to bail anyone out. Think about what that means next to everything we just walked through. The dollar must expand forever or it collapses. Bitcoin does not have to expand at all. It doesn't need new borrowers to keep it alive. It doesn't need to devalue itself to service somebody's interest. It is the first money I ever encountered that isn't a claim, isn't a debt, and isn't running from its own collapse. In a system whose survival depends on making more, Bitcoin's entire nature is that no one can make more. 21 million. Fixed. That's not a feature they added, that's the whole thing. That tool I mentioned is at timtalksfinance.com/members. It takes your real savings, applies the actual expansion of the money supply, not the polite 2%, the real number, and shows you what it's cost you, and what those same dollars would have done in Bitcoin, the one supply that can't be expanded. It's part of the membership. I built it because seeing it in your own numbers hits different than hearing me say it. I'm not going to tell you what Bitcoin's price does next year. I told you at the start I'd answer the interest question honestly, so let me be just as honest here. Nobody knows the short term. What I know is the structure. A debt-based dollar must dilute the saver. That's not an opinion. It's the arithmetic that finally answered my customer's question. And exactly one asset sits completely outside that arithmetic. You don't have to move your whole life into it. But a man guarding the savings of a lifetime should understand that the leak in his bucket is permanent by design, and that there is exactly one container that doesn't leak. That's the choice. I'm just making sure you can see it clearly. So, that customer, years ago, who stumped me, the answer to his question is this: the money to pay the interest comes from the next person's debt, and the next forever, because if it ever stops, the whole thing falls down. That's how banks really make money, not by lending what they have, by manufacturing what they don't, and requiring the whole world to keep borrowing so the math never comes due. And the only way I've ever found to step off that treadmill is to hold something the treadmill can't print. No debt behind it, no issuer above it, no obligation to grow, just 21 million fixed in a world that has to make more of everything else or die. If you want to see what the machine has done to your own money, it's at timtalksfinance.com/members. Next time, I'm taking you inside the deal that shows how the rules of this machine get bent, and how that bending blew up the entire system in 2008. I'm Tim. I'll see you there.